One of my clients left $11,000 on the table last year. It wasn't from a bad deal or a missed opportunity. It was from 5 specific deductions that they were already qualifying for, but never claimed. And it's because they had bad bookkeeping. Frankly, it was a disaster. If you're a real estate investor, listen closely. I see this pattern every single week. You're making money, you're managing properties, but you're systematically overpaying the IRS by thousands. Not because the tax code is against you, but because of a few correctable mistakes in how you track your activity. In the next few minutes, I'm going to walk you through the 5 most common high-value deductions I see investors miss. I'll explain why these are so easily lost and give you the exact steps to capture them. I run flat rate bookkeeping. We specialize in getting property owners' finances organized so they don't have to worry about hourly billing. And we see the same painful patterns across hundreds of clients. Investors are active. They're visiting properties, coordinating with contractors, and handling tenants. But their bookkeeping is an afterthought. It's a shoebox of receipts and a bank statement they glance at once a year. And this disorganization isn't just stressful, it has a direct cost. Every missed deduction is money you're handing over unnecessarily. Multiply that over a few properties and years, you're talking about $5,000 or $10,000 that could have been in your pocket. First, mileage and travel. This is the silent profit killer. Every trip related to your property is deductible. Driving to check a vacancy, meeting a contractor, a tenant walkthrough, picking up supplies. The miles add up incredibly fast. At the current standard rate, a mere 5,000 business miles is $3,200 deduction. And it's not just local. Travel to out-of-state properties or closings count. A flight for a closing, the rental car for business days, the hotel nights tied to the meeting, all deductible. The problem is always documentation. Most investors don't have a real mileage log. They remember the big trip, but forget the dozens of small ones. A property who visits twice a month, meets contractors quarterly, and does supply runs can easily log 150 to 200 miles per property. That's over $1,000 per property left on the table. With multiple rentals, it's thousands every year. Second, and a big one, repairs versus improvements. The IRS rules are specific, and misclassifying them is a major audit flag. A repair, patching a leak, fixing a faucet, repainting, maintains the property's current condition and is fully deductible. However, an improvement, replacing a roof, kitchen renovation, adding a deck, this adds value or extends useful life. That cost must be capitalized and depreciated over the years. Two are very different tax treatments, and the IRS cares which one you use. I've seen investors try to deduct a full $15,000 kitchen remodel at once. It's an audit flag. The key question is, did this make the property better than when I bought it? If yes, it's an improvement. If it just restored it, it's a repair. Remember, improvements aren't lost. They're depreciated over 27.5 years. The critical part is getting it right on the books to avoid unwanted attention. Third, the home office. Often misunderstood or avoided out of the audit fear. If you have a space used exclusively and regularly to provide your rental business, you can deduct a portion of your housing costs, mortgage, interest, taxes, utilities. It's calculated by square footage percentage. For many, this is a $1,500 to $3,000 annual deduction. 15 minutes to measure your office and your home, calculate the percentage, and write down is the difference between a $2,500 deduction and nothing. Fourth, casualty and theft losses. If your property is damaged by a federally declared disaster, firestorm or flood, or property is stolen, you may be able to deduct the loss. This is distinct from normal repairs. It requires documentation like photos, police reports, insurance claim, or an estimate, all reported correctly on Form 4684. The event must be sudden and unusual. Hurricane qualifies, but for example, termites do not. Finally, the fifth drain, professional fees. The irony here is thick. You pay professionals to help run your business, then forget to deduct those expenses. Property management fees, legal fees for leases or evictions, accounting and tax prep like my service, related to the rentals, even your bookkeeping service, all deductible. If you're paying for services to manage your assets, you must track and claim them. Don't pay to protect your assets, then fail to protect the tax benefit of that payment. I understand that you got into real estate for cash flow and wealth building, not tax strategy. But the difference between a good year and a great year often comes down to this paperwork. The investors who treat bookkeeping as a core to their business, separating finance, tracking receipts digitally, reviewing P&Ls quarterly, are the ones capturing every dollar of value. From my perspective, the fear of an audit or the headache of backtracking for an accountant keeps people from being diligent, but the system rewards organization. Clean books don't just save you at tax time, they give you a true picture of your cash return, helping you decide which properties to hold or sell. I had a client who thought they were netting 8% on a property. After we properly categorized expenses, including a missed home office deduction, a full year of unlogged mileage, and professional fees they paid but never deducted, their true net was closer to 11%. That's 3% spread across a portfolio is life-changing money. It's not just a tax defense, it's a strategic adventure that compounds. So what do? You don't need a complete overhaul. Start with these 4 moves. Get a mileage tracker app today. Use your phone. There's apps like Mile IQ or Everlance. Create a simple folder system. For each property, have a digital folder. Use subfolders for receipts, leases, contracts, and insurance. Snap a photo of receipts with your phone and upload to Google Drive. Accounting software. A simple spreadsheet or programs like QuickBooks or Stressa let you categorize expenses from day one. This is a non-negotiable. It turns receipts into organized data, and when your CPA asks for the numbers, you'll hand over a clean report. Consult a pro once. Pay a CPA for 1 hour to review your setup. Ask specifically about repairs versus improvement rules and home office eligibility. Bring your mileage log, your folders, and your questions. That 1 hour can save you thousands and create a custom playbook just for you. If this was helpful, hit that subscribe button. We break down the financial side of real estate investing weekly to help you keep more. Drop a comment and tell me which of these 5 areas is the mestest in your books right now. The unlogged mileage, miscategorized repairs, or home office deduction you've been avoiding. Let's discuss, and if you're ready to get your bookkeeping off your plate and ensure you never miss a deduction, check the link in the description to learn how our flat rate service works for investors like you. Thanks for watching.